Hi, a pleasant day to all of you. I am Professor Patricia M. Empleo to discuss with you our topic, leases. So let me start by sharing my screen. So at the end of this topic, the whole of leases, you should be able to state the nature of lease and identify its essential elements. I'm just transferring my... You should be able to account for leases in the books of the lessee and present the lease-related accounts in the financial statements of the lessee. Then you should be able also to account for leases in the books of the lessor and, of course, present lease-related accounts in the financial statement of the lessor. Towards the end, you should be able to record the sale and leaseback transactions and then identify the required disclosures in the notes to the financial statements, both in the financial statements of the lessee and the lessor relating to leases. So this topic is divided into 3 videos. So we now proceed to part 1. So in this part 1, so after viewing completely the video, you should be able to state the nature of lease and identify its essential elements, account for leases in the books of the lessee, so we will concentrate in the books of the lessee only, present the right of use asset and lease liability in the financial statements, and identify the required disclosures relating to leases in the financial statements of the lessees. Okay, so we will now determine whether a contract is or contains a lease. So why is it important? So to determine whether this IFRS is applicable both from the point of view of the lessee and the lessor. So if the contract is a lease, then you have to stay with this IFRS 16. If the contract does not contain a lease, then you have to shift to other IFRSs with, let us say, property, plant, and equipment if the asset is one of PPE, or IAS 38 intangible assets or investment property, or in some cases even IAS 2 inventories. Now, from the point of view of the lessor, you have to determine whether the contract is a lease, or from the point of view of the supplier, you have to determine whether the contract is a lease or is not a lease, because if it is a lease, then you have to stay with this standard. If it is not a lease, then you have to shift probably to IFRS 15, revenue from contracts with customers. Okay, so a contract is or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Therefore, there are 2 phrases highlighted in this definition of contract of lease. And these 2 essential elements are, first, there is an identified asset, and second, the contract contains the right to control the use of that identified asset. And therefore, we explore these two essential elements. So when does a contract specify an identified asset? So there is an identified asset in the contract if that asset is specifically identified in the contract. Therefore, the characteristic of the asset, the specific nature or the specific item, the specific description of the asset, if it has a serial number, then that serial number must be contained in the list. Or the terms of the contract can be fulfilled by the lessor by the use of that asset only, or by the supplier. So the terms of the contract can be fulfilled by the supplier by the use of that asset, and that use of that asset is actually transferred to the customer. So if the supplier has the substantive right to substitute the asset, then there is no identified asset in the contract, meaning that if the asset can be withdrawn by the supplier and it would be convenient or practically possible for the supplier to substitute another asset, and that substitution will benefit, economically benefit the supplier, then in effect, there is no identified asset. The right of substitution is substantive if the supplier has the practical ability to substitute an alternative asset, and that substitution, again, would economically benefit the supplier from such substitution. So again, there must be an identified asset, and that there must be no substantive right of the supplier to substitute that asset. The second element is the conveyance of right to whom? This is conveyance of right to the customer to control the use of the identified asset. Therefore, the customer receives the right to control the use of the identified asset if the customer obtains substantially all of the economic benefits from the use of the identified asset. These economic benefits obtained by the customer may be in the form of possible inflow or probable inflow of cash because of revenue generated by that identified asset, or it may be probable decrease in operating costs because of the use of the identified asset. And that customer can direct the use of the identified asset. So that means that the customer obtains the right to direct how and for what purpose the asset is to be used. Therefore, if it is the customer that makes a decision as to how the asset will be used and how the asset will contribute to inflow of economic benefits to its business, then the customer receives the right to control the use of the identified asset. Also, the decisions about how and for what purpose the asset is used are actually predetermined at the inception of the contract. Okay, so based on these two elements, let us determine now whether the following contracts contain or are leases. So the examples presented here are taken from the Intermediate Accounting, Volume 3 by Robles and yours truly. So case A, supplier L provides customer M the use of 5 delivery vans of particular type for a term of 5 years. The contract specifies the vans, therefore they are enumerated in the contract, and customer M has the decision where the goods will be delivered and the types of goods to be delivered. Customer M can use the vans for whatever purpose except for delivery of illegal drugs, explosives, firearms, and other items of similar nature. Supplier L is required to substitute a van that may require repairs and maintenance service. Okay, therefore in this contract, the contract specifies the vans that will be conveyed to customer M. And customer M can use the vans for whatever legal purpose. So the fact that there is a provision in the contract that the vans cannot be used for delivery of illegal drugs, explosives, firearms, and other items of similar nature are just necessary to physically protect the vans. And actually, that is normal for the supplier to protect these assets. Therefore, this one is a contract of lease. Even if supplier L is required to substitute a van that may require repairs and maintenance, this substitution is not substantive because supplier L will not receive any economic benefits from that substitution. In fact, that substitution is an obligation to ensure that the business operations of customer M is not affected for any damage or any repairs needed for such vans. Therefore, again, in case A, this is a contract of lease. Therefore, this IFRS 16 will apply. Then case B, accountant T company enters into a contract with supermalls to use a space for a kiosk, which accountant T owns, to sell its milk tea products for a 3-year period. The contract specifies the amount of the space which may be located at any area at the mall, provided that supermalls may change the location of accountant T space with a 2-day notice. Minimal cost is incurred by supermalls in changing the space allotted to accountant T. Accountant T's kiosk can be moved easily within the mall, and there are several available areas that would meet the space requirement specified in the contract. Therefore, this is for the use of space. Therefore, let us determine whether the contract specifies an identified asset. It is stated here that the contract specifies the amount of the space, but as to where that space is not specified in the contract, because the space may be located at any area in the mall. Then supermall is expected to incur minimal cost in changing the space. Therefore, it is expected that the supplier can economically benefit from substituting the space that will be provided to accountant T. And therefore, because of this, there is no identified asset, and therefore, this is not a contract of lease. Therefore, from the point of view of the supplier, then this will be covered by IFRS 15, revenue from contracts with customers. Then the customer here will have to find some other principles to determine how the payment to the supermalls will be accounted for. So it is out of the scope of IFRS 16. Let me check first whether I have actually recorded this. Yes, I have. So let me share my screen again. Okay, we now proceed to, again, case B is not a contract of lease. We now go to case C. Jetlag Company enters into a 15-year contract with Craft Builders Company to use 3 specified jumbo jets that will fly passengers from Manila to selected cities in Asia Pacific. Jetlag makes the decisions about the use of the jumbo jets and the destination of such flights. Craft Builders owns a fleet of jumbo jets such that it can substitute any unit of jet for Jetlag Company for reason of repairs, maintenance, or malfunction. In fact, Craft Builders is obliged to substitute those jets in such cases. Okay, therefore, are there identified assets here? So let us see. So the contract actually specifies 3 definite jumbo jets, specific jumbo jets that will fly passengers from Manila to selected cities in Asia Pacific. The customer Jetlag actually receives the right to make the decision about the use of the jumbo jets and the destination of such flights. Again, just like in case A, the substitution here is not actually a benefit accruing to Craft Builders, but that is an obligation of the Craft Builders. Therefore, there is no economic benefit that will accrue to Craft Builders from this substitution. Again, this is a contract of lease. We go to the last case, case D. The contract between Indoplus and Fast Mover requires the latter, meaning Fast Mover, to transport a specified quantity of goods by using a specified type of car in accordance with a stated timetable for 3 years, renewable at the end of the term. Fast Mover provides the delivery cars, driver, and gasoline. The contract states the nature and quantity of goods to be transported and the type of car to be used that suits the nature of the goods. A Fast Mover has a large pool of similar cars that can be used for this purpose. The cars, when not in use, are parked at the Fast Mover's premises. Okay, so first question, is there an identified asset? What is specified here is only the type of car that may serve the purpose of Indoplus. Other than that, it is still the Fast Mover that controls the right to use the asset, because these cars are still parked within the vicinity of Fast Movers. Therefore, this is simply a contract of transporting the goods of the customer, probably to its respective customers also. Therefore, this one is actually a contract of freight. So this is out of the scope of IFRS 16, and probably from the point of view of Fast Mover, this will be under IFRS 15. Okay, so assuming that the contract contains or is a lease, how do we account for such contract? We are now going to accounting in the books of the lessee. So again, if the contract specifies an asset and that the right to control the asset is transferred from the supplier to the customer, then the contract is one of a lease. Therefore, the party that receives the right to control the asset is called the lessee, whereas the party which provides the customer that right in exchange for consideration is called the lessor. Therefore, we will now proceed to accounting for leases first in this video in the books of the lessee. So in the books of the lessee, these are the general principles. You are to recognize at commencement. Commencement is the first day of the lease contract. So you are to recognize at commencement a right of use asset and a lease liability. So you are to debit therefore a right of use asset and you are to credit a lease liability. Initial direct costs, what are these? Initial direct costs are the costs incurred by the lessee in consummating the lease contract. Therefore, this may include payment to finder of lessor, or payment to finder of property. Also, it may include legal costs to execute the lease contract. So these are, in effect, directly attributable costs. And also estimated costs for dismantling and removing the asset to the extent that this constitutes a constructive obligation, or the cost of restoring the site, that is at the end of the lease term or the useful life of the asset, are part of the asset costs. Therefore, this inclusion of the principle in IFRS 16 is now aligned with IAS 16, property, plant, and equipment, because in IAS 16, the total initial cost assigned to items of property, plant, and equipment would constitute first the purchase price, 2 directly attributable costs, and 3 the estimated cost of dismantling, which is established at the date of initial recognition, provided that there is either legal or constructive obligation for such cost of dismantling. So they are now all aligned. So IFRS 16 and IAS 16 are now aligned. Therefore, at the commencement, this is our pro forma entry. Debit the right of use asset, debit cash for any immediate payment, credit lease liability at the present value of future periodic payments, and to capitalize the estimated cost of dismantling, credit provision for dismantling. Again, this has to be discounted using an implicit interest rate. So how do we measure the lease liability? The following are included in the measurement of the lease liability. First, the fixed payments, including in substance fixed lease payments, and less any lease incentives. So if there is a reduction in the lease payment that is provided for by the lessor, then this deduction from the lease payment will have to be deducted from such fixed payment. We have variable lease payments that depend on an index or a rate. Example, if the lease payment is based on a future consumer price index, then that is to be included as part of your lease liability. However, contingent rentals that are based on revenue or usage are not included in the measurement of lease liability. Example, in addition to periodic payment of, let us say, 1 million every year, you are required to pay 5% of your sales in excess of, let us say, 20 million. Therefore, that 5% is contingent rental and is taken to profit or loss and is not part of your measurement of lease liability. The third one is estimated residual value under residual value guarantees. Therefore, the third one would apply if the lease contract provides for guarantee by the lessee of the residual value, which we will explain a little later. Letter D is bargain purchase option. Bargain purchase option is a privilege that is granted by the lessor to the lessee, such that the lessee has the option to buy the property at an amount that is significantly lower than the fair value of the property at the date the option becomes exercisable. Example, if the lease term is for 5 years, but the estimated useful life of the asset is, let us say, 8 years. So at the end of the lease term of 5 years, you are given the privilege to buy the property at, let us say, only 200,000, even if at the end of the 5-year period, the estimated fair value of the asset would be, let us say, 1 million, and therefore the bargain purchase option or the purchase option is significantly lower than the fair value at the date the option becomes exercisable. The reason why it's called bargain. Therefore, you have to include the present value of the bargain purchase option in the measurement of the lease liability if at the date of commencement or at the date of the inception of the lease, it is reasonably certain already that the lessee will exercise that bargain purchase option. The last one is payment of penalties for termination under lessee's termination option. So if there is a provision in the contract that you cannot terminate during the lease term, and doing so will require the lessee to pay that penalty, then that penalty is part of the measurement of the lease liability. Therefore, even without enumerating, we can summarize that all payments by the lessee accruing to the benefit of the lessor are included in the measurement of the lease liability except for contingent rentals or rentals that are based on revenue or usage during that period, because these contingent rentals are taken to profit or loss in the period incurred. So in determining the present value of the lease liability, what interest rate is to be used? IFRS 16 specifies the discount rate to be used to be, first, the rate implicit in the lease, if that rate is practicably determinable. The rate implicit in the lease is actually the desired rate of return of the lessor. Of course, in most leases, this is not disclosed by the lessor. However, if the fair value of the property is determinable, as there is an equivalent cash price for that property, then you may compute for the implicit rate in the lease using your application or web application for determination of the desired rate of return. If this is not practicably determinable, as even the fair value of the lease asset is also not given because the asset is so unique in nature, then you are to use your own incremental borrowing rate. Again, we are speaking here from the point of view of the lessee. Therefore, if the lessee cannot practicably determine the implicit rate of the lessor, then the lessee shall use its own incremental borrowing rate. So they are presented here in the order of priority. Again, our first priority is the implicit rate. If this is not determinable, use the lessee's incremental borrowing rate. In the subsequent periods, how do we measure the lease liability? So, over the lease term, the lease liability is to be decreased by the amount of periodic payment applied to reduction of lease liability. Because the lease liability is a financial liability, then your periodic payment of rent will be recorded in this manner: debit interest expense, debit lease liability, and credit cash. The debit to interest expense is based on your amortization table using the effective interest method. So the periodic payment will have to be applied first to interest, and then the balance will be applied to reduction of the principal. Now, if the lease anniversary does not coincide with the end of the reporting period, which is generally the case, then at the end of the reporting period, you have to prepare an adjusting entry to accrue such interest expense because interest accrues with the passage of time. Therefore, your entry here is to debit interest expense and credit lease liability. What about the right of use asset? The right of use asset will be classified and measured according to the nature of the asset. Therefore, it may be classified as property, plant and equipment, investment property, or intangible assets. And based on their classification, you have to measure them at financial statement dates. Executory costs. What are these? Executory costs are costs of ownership. So this may be incurred by the lessee because the right to ownership or the right to control the asset has been transferred already to the lessee, and therefore the risk relating to the asset may also be transferred to the lessee. Therefore, the executory costs may include here repairs, maintenance, insurance, and property taxes. Therefore, these executory costs are not capitalized as part of the cost of the right of use asset, but they are charged to profit or loss using the appropriate expense recognition principle. So if the cost is one of repairs and maintenance, then repairs and maintenance are immediately charged to expenses. If the cost is, let us say, insurance, then insurance is a time-related cost. So it depends on the term or the time of the insurance coverage. Now, depreciation method depends on the expected transfer of title, meaning it depends upon the expected period for which the asset is to be used. If there is expected transfer of title, so if the lease contract states that at the end of the lease term, the title to the property will automatically be transferred to the lessee. Therefore, in substance, the lease contract is actually payment or purchase by the lessee on installment basis of that property, in which case at the end of the lease term, such ownership is automatically transferred to the lessee. Therefore, the lessee will use the asset over the total expected useful life of the asset. Or if there is a bargain purchase option, such that upon payment by the lessee of the bargain option price, the title to the property will be transferred to the lessee, then your depreciation period is the useful life of the asset. But if there is no expected transfer of title, as there is no provision in the lease contract and there is no bargain purchase option, then you are to depreciate the asset over the lease term, because this is the period in which the lessee receives the benefit from the use of the asset. And in computing the depreciation, you are to consider only the guaranteed residual value. Therefore, if there is no, again, expected transfer of title, how do we compute depreciation? If depreciation is computed using a straight line method, that is capitalized cost minus guaranteed residual value divided by the lease term. Again, the measurement basis is according to classification of the class to which the asset belongs. If it is one of property, plant, and equipment, therefore, such right-of-use asset must be measured in accordance with the two options provided under IAS 16 and IAS 38, the cost model or the revaluation model. If the right-of-use asset is qualified as an investment property and the lessee applies the fair value model for its investment property, then measure at fair value. Again, please take note that the choice of the model applies to all investment property held by the entity. Therefore, if the entity uses the cost model, then the right-of-use asset classified as investment property will be measured at cost minus accumulated depreciation. If the lessee uses the fair value model for all its investment property, then the right-of-use asset will have to be measured at fair value. Be guided by the respective IFRSs. So in the financial statement of the lessee, the right-of-use asset must be presented separately, either on the face or in the notes. So you may include that in one line item in property, plant, and equipment on the face, but you have to mention in the notes that part of property, plant, and equipment is a right-of-use asset. Same is true for right-of-use asset classified as investment property or intangible assets. Again, you may use the face to present it separately, or you may use the notes to present it separately. The lease liability shall be presented again separately, either on the face or in the notes. So you may lump financial liabilities, or you may present separately on the face lease liability. Then you have other financial liabilities. If the company uses the current and non-current presentation of assets and liabilities in the statement of financial position, then the lease liability will have to be apportioned into current and non-current portion, which we will exemplify later. Okay, so we now go to this illustrative problem 1. Again, this is taken from the book Intermediate Accounting by Robles and Empleo. On January 1, 2020, Generous Incorporated leased 2 automobiles for executive use. The lease requires Generous to make 5 annual payments of $260,000. So for our Indonesian students, this P is actually peso sign. You may disregard it. You just consider it as a unit of currency. beginning January 1, 2020. Therefore, the lease commencement is January 1, 2020. At the end of the lease term, December 31, 2024, generous guarantees that the residual value of the automobile will total 200,000. So what is that guaranteed residual value? Generally, the lessor computes the periodic payment considering that the lessor will desire a rate of return on the cost of the asset. Therefore, if the lease term is for 5 years, is it 5 years? Let us count 2020, 21, 22, 23, 24. Therefore, the lease term is for 5 years, but the estimated useful life of the automobiles is 6 years. Therefore, it is not rational that the lessor will recover the full cost of these automobiles over 5 years only, because the useful life extends 1 more year from the end of the lease term. Therefore, the lessor would want to have an assurance that at the end of the 5-year lease term, the asset will still have a value of 200,000. If not, any difference or any amount that is lower than 200,000 will have to be paid by the lessee. Again, in this contract, there was a guaranteed residual value, meaning that both the lessor and the lessee agreed that at the end of the lease term, the asset will be returned by the lessee with an economic value still of 200,000. If in any case, the value of the asset falls below 200,000, any discrepancy below this 200,000 will have to be paid by the lessee. Therefore, this is an obligation of the lessee to return back the asset, to return the asset to the lessor at that amount of 200,000. Otherwise, cash payment will be made by the lessee if the residual value of the asset falls below 200,000 at the end of the lease term, in which case the residual value here is guaranteed. So the property reverts to the lessor at the end of the lease term. The estimated useful life of the automobiles is 6 years, and Generous uses a straight line method for all its assets. Generous incremental borrowing rate is 10%. The interest rate implicit in the lease, which is known to Generous, is 9%. Therefore, you have to choose between 9% and 10%. Therefore, in the order of priority given by IFRS 16, from the point of view of the lessee, if implicit rate can be practicably determined, then you are to use the implicit rate. In this case, the implicit rate is known by lessee, so we will be using 9%. Therefore, let us compute for the capitalized cost of the asset. So we have cash payment of 260,000. That is an immediate payment at inception. Then there are 4 more periodic payments of 260,000. Therefore, this 260,000 will have to be discounted using an implicit rate of 9%. These are 4 more future periodic payments. We have included here already the advance payment. Therefore, the present value factor that we will use here is present value of ordinary annuity, wherein the next payment will be made a year after we make this payment of 260,000. Therefore, the present value of remaining payments discounted at 9% for 4 more periods is 842,322. Now, the lease liability and the asset will include also the present value of the guaranteed residual value. At the end of the lease term, there is an obligation by the lessee to return the asset at least with an amount of 200,000. Whether this is to be returned in the form of the physical asset or in the form of cash payment, that is an assurance that is made by the lessee. Therefore, this is to be rendered, this is an obligation at the end of the lease term, so the present value factor that we will use here is the present value of a single amount discounted at 9% for 5 periods, which is 0.6499. So the present value of the guaranteed residual value is 129,980. So the total cost of the asset is 1,232,302, such that at inception or at commencement, our entry is to debit right of use automobiles 1,232,302, credit lease liability at the present value of future payments including the guaranteed residual value, and credit cash for the immediate payment of 260,000. Okay, therefore, we have to prepare our amortization table. So after the immediate payment of 260,000, that our lease liability is now 972,302. Therefore, in your amortization table come next year, 2021, again, the lessee will make a payment of 260 because there is 1 year time lapse from January 1, 2020 to January 1, 2021. Interest accrues already at 9% of the previous lease obligation. So that is 9% of 972,302. So that's 87,507. So from 260,000 periodic payment, deduct amount applied to interest of 87,507. Therefore, the amount applied to reduction in principal is 172,493, which will reduce the previous principal of 972,302. So this amount minus 172,493, the new balance of the principal is 799,809. And the process continues until the end of the lease term. Now, at the end of the lease term, it is expected that we will return the asset at its guaranteed residual amount of 200,000. Therefore, this is considered also as payment of lease liability. So, from January 1, 2024 to end of the year, there is still interest accrued. Therefore, we have 16,530 amount applied to interest. There is an asterisk here signifying that this is actually rounded off because at the end of the lease term, your lease liability will have to be brought to zero. So if you are to do manual or Excel computation, we will have a certain difference here. But this difference is just due to rounding off. What is important at the end of the lease term is that you have to bring the lease liability to zero. Therefore, what is adjusted is the amount that is applied to interest expense. Okay, therefore, on December 31 of 2020, even if this payment is to be made on January 1, 2021, if we are to prepare our financial statements, of course, at year end, assuming that the company uses the calendar year, which is actually stated already in the problem, then we have to accrue interest from January 1 to December 31. Although in your amortization table, this is just application of payment, but this interest will have to be accrued at year end. Therefore, your entry there is to debit interest expense, 87,507, credit lease liability, 87,507. And then, depreciate the asset. Again, there is no expected transfer of title, so the asset will have to be depreciated over the lease term of 5 years only. And in considering the depreciable cost, you have to consider only the guaranteed residual value. So we debit depreciation expense, credit accumulated depreciation. That is 206,460. Such that come the next periodic payment, your entry to record the periodic payment is to debit lease liability to 60,000 and credit cash for 260,000. The full amount already is debited to lease liability because we have included the accrued interest to the lease liability balance the day before this periodic payment, and that was at the end of the reporting period. Again, on December 31, based on your amortization table, you have to accrue this interest expense and credit lease liability and take up also your depreciation expense. So based on our entries for 2020 and 2021, how will our lease-related accounts be presented in the statement of financial position? Okay, so this is our financial statement presentation as of December 31, 2021, included in your non-current assets. We have right-of-use equipment. So this is under supposedly property, plant, and equipment. So we have right-of-use equipment at its capitalized cost of 1,232,302. We have accumulated depreciation for 2 years. That is 206,460 times 2. So that is 412,920. Therefore, the carrying value of the asset is 819,382. If this is classified as property, plant, and equipment, then you have to subject this to impairment testing, provided that there is an indication of impairment. Now, in the liability section, assuming that the company presents assets and liabilities into current and non-current, you have to apportion the lease liability into current and non-current. So the current portion of the lease liability is the amount of the periodic payment applied to principal plus the accrued interest as of December 31. So this is 188,017. We go back to our amortization table. Our statement of financial position is dated December 31, 2021. Therefore, the amount of the principal that will be paid next year, and next year is 2022, is 188,017. Therefore, this portion is classified as current liability. Plus, of course, the interest accrued as of December 31, 2021. Therefore, that's a total of 260,000. This amount, 71,983. Therefore, your liability non-current will be this portion, 611,792. We go back. Okay, therefore, the current portion of the lease liability again is the portion of the principal that will be paid next year. So next year is 2022. And the amount of accrued interest as of December 31, 2021. Therefore, that's a total of 260,000. Then the remaining portion of the lease liability is classified as non-current. In the statement of comprehensive income, what will be presented? So you are to present depreciation expense of 206,460, and you have to present as finance cost the interest expense of 71,983. If there are any executory costs incurred by the lessee, then you have to present them as expenses based on your appropriate expense recognition principle. Okay, so our first illustration actually is one of a lease contract that has guaranteed residual value, and therefore at the end of the lease term, the asset is expected to be returned to the lessor. Okay, so you might ask what will happen at the end of the lease term. So the end of the lease term is December 31, 2024. Therefore, this will be our entries on December 31, 2024. Because this is also the end of the reporting period, you have to prepare entries to update the accrual of interest, and therefore this is your accrual. Debit interest expense, 16,530. Credit lease liability, 16,530. And also depreciate the asset to complete the 5-year lease term depreciation. We debit depreciation expense credit accumulated depreciation. Therefore, after these entries, you are now ready to record the turning over of the asset to the lessor. Please correct this. I will not correct anymore, or I may correct it here. Just wait. Okay. Okay, so wait, I will just delete the dates for us to have correct entries. Then I have to go back to share screen. This is using technology. And wait, this is 2022. Share. View. Slideshow. Then I'll go to 22. Okay, here. Okay, at the end of the lease term, again, you have to update your accrual of interest for the last time. You have to depreciate the asset for the last time. And then you are now ready to turn over the asset to, you are now returning the asset to the lessor. That means, therefore, that you are returning the asset to the lessor. Therefore, we will derecognize all related lease accounts. So, to derecognize the lease liability, which has been brought already to a balance of 200,000, that's 183,470 plus 16,530 through this entry. We debit lease liability 200,000, debit accumulated depreciation, that is 206,460 times 5, so that is 1,032,300, and credit the right of use asset for 1,232,300. Now, if ever the fair value of the asset is more than 200,000, the lessee will not benefit from that excess of fair value. Still, your entry will remain the same. There is no financial benefit that will be accruing to the lessee. Therefore, your entries will be the same. If the asset, let us say, has a value of only 150,000, then you have to pay for 50,000, and you have to recognize an impairment loss. So your entry will be revised. Debit lease liability 200,000, debit impairment loss 50,000, debit accumulated depreciation 1,032,300, credit right of use asset 1,232,300, and credit cash for 50,000. Okay, so again, that's one example with guaranteed residual value. Now we go to illustrative problem 2, almost the same. Let us determine what is the difference in this illustrative problem. On January 1, 2020, Generous Incorporated leased 2 automobiles for executive use. The lease requires Generous to make 5 annual payments of $260,000 beginning January 1, 2020. At the end of the lease term, December 31, 2024, the estimated residual value of the asset, which is not guaranteed by Generous, therefore that's the difference, is 200,000. Still, the property reverts to the lessor at the end of the lease term, even if that is not stated, based on the term that there is residual value and the lease term is for 5 years, even if the estimated useful life of the asset is 6 years, then it is expected that the asset will still be returned to the lessor, except that the lessor here is a little kinder because there is no obligation imposed to the lessee that any amount below that residual value of 200,000 will be required to be paid by the lessee. Therefore, how will our solution differ now? Because the residual value is not guaranteed, it will not be considered by the lessee in the computation of the capitalized cost of the right-of-use automobiles, not even in the measurement of the lease liability, because the lessee has no obligation to return the asset at that amount. It has only an obligation to return the asset, but not necessarily with an assured value of 200,000. Therefore, any residual value that is not guaranteed by the lessee is disregarded by the lessee, first in the computation of the capitalized cost of the asset, second in the computation of the present value of the lease liability, and third in the computation of depreciation. Okay, therefore, the capitalized cost of the right-of-use automobile is now revised to only 1,102,322. And the present value of the lease liability is limited only to the present value of 4 more periodic payments of the rental. Therefore, our entry at commencement is revised. Debit right-of-use automobiles, 1,102,302, credit lease liability, 842,302, and credit cash for 260,000. Therefore, we will be modifying our amortization table. So we start with 842,302 after making the immediate payment of 260,000. So the basis for the computation of the interest is this starting point. So this is 9% of 842,302. So that's 75,807 deducted from 260. Therefore, the amount that will be applied to reduction in principal is 184,193. Therefore, the principal at the end, after the lease payment, the second lease payment, is reduced to 658,109. Of course, if the reporting period of the lessee is the calendar year, this interest accrued is to be taken up not on January 1, but on December 31, 2020. Again, so on December 31, 2020, your entry for the accrual of interest is to debit interest expense, 75,807, credit lease liability, 75,807. Then, your depreciation here is based only on the capitalized cost without regard to the unguaranteed residual value. Again, your depreciation period is the lease term. So it's just 842,302 divided by 5. So that's 168,460. We did not deduct the unguaranteed residual value because in the first place, the present value of the unguaranteed residual value is also not included in the 842,302. Therefore, on January 1, 2021, similar to our previous entry, the entry for the second periodic payment is to debit lease liability and credit cash. Again, at the end of 2021, based on this amortization table, we debit interest expense 59,230 and credit lease liability 59,230. Then take up again your depreciation at year end. Okay, so going back to this, what will happen at the end of the lease term? At the end of the lease term, your liability, in fact, as early as January 1, 2024, your liability is already zero. After taking up the last entry for your depreciation of 168,460, you are to close both accumulated depreciation and the right-of-use asset. So your entry there is just to debit accumulated depreciation and credit right-of-use asset. Any difference due to rounding off will have to be considered also. So after preparing that entry, actually after preparing that entry, your asset as well as its accumulated depreciation has been recognized already, and then you have to physically return the asset to the lessor, but it will not affect your accounting entries anymore. You have just to state as part of your memorandum entry that the right of use asset has already been returned to the lessor. Again, at December 31, 2024, you only need to prepare this entry, followed by another entry closing both accumulated depreciation and the right of use automobile. We now go to illustrative problem 3. So let us look for the difference here. On January 1, 2020, Generous Incorporated leased 2 automobiles for executive use. The lease requires Generous to make 5 annual payments of $260,000 beginning January 1, 2020. The lease provides an option to Generous to buy the asset for $200,000 at December 31, 2024, when the fair value of the asset is expected to be $450,000. The estimated life of the asset is 7 years with estimated residual value of $150,000. So the residual value of $150,000 is at the end of the useful life of 7 years. Generous uses a straight line method for all its assets. The incremental borrowing rate is 10%. The interest rate implicit in the lease, which is known to Generous, is 9%. So what do we have in illustrative problem 3? We have now a bargain purchase option. Why is it bargain? Because the option price offered to the lessee is $200,000, even if at the end of the lease term, the estimated fair value is projected at $450,000. Therefore, $200,000 is considered to be significantly lower than $450,000. So, if at the end of the lease term, Generous would pay $200,000, then the title to the asset will be transferred from the lessor to Generous, such that Generous can use the asset for the entire useful life of 7 years. We are assuming in this case, in our solution, that as early as the commencement, it is already reasonably certain that Generous would exercise the purchase option. Therefore, how do we compute? Your cash payment is $260,000. The present value of the remaining payments for 4 more periods is $842,322. And then it is expected that Generous will pay the bargain option price of $200,000 at the end of the 5-year lease term. Therefore, similar to guaranteed residual value, this is also capitalized. So your capitalized cost is $1,232,302, and that your present value of the lease liability also includes the present value of the bargain option price. So on January 1, 2020, our entry is to debit right of use automobiles, $1,232,302, credit lease liability, $972,302, and credit cash for the immediate payment of $260,000. Therefore, your amortization table is similar to our amortization table in illustration 1. Hence, our entry for the accrual of interest is the same as our entry in illustration 1. This one, $87,507, although to be paid, applied to interest on January 1, 2021, will have to be accrued at December 31, 2020. So we debit interest expense, credit lease liability. Now, please take note that in the computation of depreciation, what we consider here is the estimated residual value at the end of the useful life of the asset, which is 7. Therefore, capitalized cost minus the estimated residual value at the end of the useful life, because it is expected that we will be using the asset over their estimated useful life of 7 years, divided by the estimated useful life of 7 years. So we debit depreciation expense 154,615 and credit accumulated depreciation 154,615. Then to record payment of lease liability, debit lease liability to 60,000, credit cash to 60,000. Then accrue again at the end of 2021 for your interest, and then record, update your depreciation. Okay, so what happens at the end of the lease term? At the end of the lease term, it is expected that the right of use asset still has a carrying value. Its carrying value will be its cost of, again, 1,232,302 minus the 5-year accumulated depreciation. So there is still a remaining carrying value. Then to record your payment of your bargain option price, just debit interest expense, debit lease liability, and credit cash for 200,000. Now, to signify that the asset is not being leased anymore, but the asset already is transferred in your name as far as title is concerned, then you simply transfer the ledger balance of the right of use asset to automobiles. So debit automobiles, credit right of use asset dash automobiles. Whatever also is the accumulated depreciation will have to be transferred to accumulated depreciation automobiles. So your entry there, debit accumulated depreciation right of use automobiles, and credit accumulated depreciation automobiles. So after this entry, what will prevail would be the ledger balance for automobiles, meaning they are yours already, reduced by accumulated depreciation automobiles. Okay. So what we have discussed so far are actually the general principles for leases from the point of view of the lessee. This is actually the main change in IFRS 16. Therefore, in IFRS 16, there is no operating leases except for this. Okay, so there is an option that is offered to the lessee to use the general principle in accounting for leases. Therefore, the general principle is that the lease payments will have to be capitalized as cost of right of use asset, and you have to present your lease liability for your succeeding lease payments. That is actually applying substance over form. However, for these leases, you have the option, meaning you have the alternative not to use the general principle of capitalizing the right of use asset and recording the lease liability. And this is limited only for leases of low value assets. In IFRS 16, the example given for low value assets is up to computer notebooks. Or for leases that cover only a period not exceeding 12 months. Again, the option to use this exemption, of course, the general rule is that you are to capitalize them still as capitalized right of use asset or finance and record finance lease liability. However, for practicality, the lessee has the option on a lease-by-lease basis not to capitalize the asset, but to record the payment either as prepaid rent or rent expense with appropriate adjusting entries at year end. Again, limited only for leases of low-value assets and for short-term leases. So when this exemption is exercised, the lease payments are charged to profit or loss based on a straight line, unless another systematic basis is more representative of the benefits from the asset. When we use a straight line, even if periodic payment is not uniform, still the total payment over the lease term will have to be divided equally over the lease period. Example, if let us say the rental for the first 3 months is, let us say, 100,000, but it will be increased to 120,000 over the remaining 9 months. Therefore, 100,000 times 3 plus 120,000 divided by 9, times 9, that will be your total of your periodic payments over the 1-year period. Then divide it over 12, that will be your rental expense over the 12-month rental expense per month over your lease term. Whatever is the difference between your payment, accumulated payment, and your accumulated rent expense is recorded either as prepaid rent or rent payable in the statement of financial position. Okay, it was specified because this exemption option given to lessee may be abused. Therefore, it is specified in IFRS 16 that the recognition and measurement exemption cannot be applied to an asset that is being subleased by a lessee. Therefore, any asset that is controlled by the lessee that is subleased to other customers cannot be considered as low-value asset. Therefore, we cannot use that exemption option. Again, the election exemption for low-value assets can be exercised on a lease-by-lease basis. The following are the required disclosures. The depreciation charges for the right-of-use asset. Such depreciation is included in the depreciation expense. So if that is not presented separately in the statement of comprehensive income, then you have to include this in the notes. You have interest expense on lease liabilities as part of finance cost presented in the statement of comprehensive income. Expenses relating to short-term leases and leases of low-value assets. So this is your rent expense. So you have to justify why you opted for that exemption. And of course, your justification is this option that is offered by IFRS 16. But you have to justify that that is short-term and that involves low-value assets. Expenses relating to variable payments not included in the measurement of lease liabilities. Therefore, these are contingent rentals that are reported as lease expense if that rental is based on variables such as usage or revenues. Income from subleasing, the carrying amount of the right-of-use asset, the maturity basis of lease liabilities. So the current portion will be maturing, of course, within next year. And the non-current portion will have to be presented separately. In fact, there is a statement there that lease payments maturing within year 2 to year 5 will have to be presented in the notes, and payments after year 5 will have to be presented also separately. So you are to do that in either a matrix format or in a schedule format. For right-of-use asset, the disclosure requirements of IAS 16, if that is classified as property, plant, and equipment, or IAS 38, if that is intangible, or IAS 40, if that is investment property. Of course, based on the nature of the right-of-use asset. and other relevant information for users of financial statements to understand the effects of leasing arrangements on financial position, financial performance, and cash flows. So to determine how these are presented in the notes, you may see publicly listed companies on how they present information related to lease transactions. Therefore, in this video, which is part 1 of leases, you should be able to state the nature of lease and identify its essential elements. By doing so, you can determine whether the contract is or contains a lease. You should be able to account for leases in the books of the lessee, identify the proper measurement basis and classification of right-of-use asset, and the lease liability in the financial statements. Of course, you should be able to present right-of-use asset in the statement of financial position, also the lease liability, also in the statement of financial position. Then the related expenses for right-of-use asset and right-of-use liabilities. And you should be able to identify, and later when you practice, prepare notes to comply with the disclosure requirements relating to leases. Therefore, this ends our part 1 of leases. So I will stop sharing and I will stop